I think gold is God's money and everything is fake.
If you have 5 crores today, how would you manage it?
I'm not going to put all my money on one horse. I'm going to distribute it between guys.
What weight you're supposed to allocate to what asset class might just differ depending on what your needs and wants are.
Keeping money in a bank, you're just getting poorer and poorer. Name one person on any wealthy list that has put his money in a fixed deposit.
How do they actually judge the risk?
There's a saying, in God we trust, everyone else bring data.
I don't want to spend money for a travel. I'll save that up, again invest, risk that money to get higher return.
Not every decision can be taken off a spreadsheet.
You are not pro debt.
Debt has been more of a convenience. We have never seen debt as an asset class.
What is Nifty 50?
Listed biggest companies in India.
Nifty is a badly designed quant strategy.
Welcome back to Leverage by Qode, where quant thinkers take the mic and we decode the markets through a sharper lens. Today, we zoom out and think bigger. This episode is about what happens after accumulation, how you actually manage a large corpus. If you had 5 crores to allocate today, how would you balance safety, growth, and peace of mind? So to discuss this, today we have Karan and Kavan. Welcome to the podcast.
Thanks.
Thanks for having us.
So topic for today is very simple. Instead of going into deep jargons, how to invest, where to invest, we'll first see from a macro view, if you had 5 crores to manage today, what would be the first thing that you could think about without seeing or focusing on returns?
In an ideal world, that information is a little limiting, honestly, because it depends on who the person is, what stage of life is the guy who's holding 5 crores is at. Is he young? Is he old? And what's his use case for the money, right? Like there are people who just want to, this is the last roll of the die and I don't have anything after this. So I just want to basically play defense. And then there are guys who are like, yeah, I've got plenty other lying at home and here I've got 5 crores more. So the answer will obviously change. How it starts off in my head is that there are multiple options available today. Like, the financial markets have become very savvy, and then there is good old simple equity, then there's debt, then there's metals and commodities, and then there's alternative investment strategies. I don't think there's any one holy grail, to be honest, right? So I think in an ideal world, if I were to generate the highest return per unit of risk, that means if I'm risking a rupee, I want to maximize the amount of money that I can make on that one rupee of risk. I would approach it with a multi-asset, multi-strategy approach. Now, when I say multi-asset and multi-strategy, all I'm saying is that I don't think I would bet all my money on one horse. I would rather tactically give money to different guys in different weights. Ideally, what will happen is that they all perform in different kind of market regimes, different type of economic cycles, different type of debt cycles. And then, therefore, you will get the smoothest journey from the bottom left to the top right. Investing is, if you're stepping outside the false security of debt, I think, and we'll get to that why I say false security. But if you're moving outside the debt markets, I think even within the debt markets also, but there is a lot of uncertainty that you have to kind of embrace, right? And the only way to kind of reduce that uncertainty is by having a multi-strategy, multi-asset deployment allocation strategy.
Let's say someone had to decide, or they had to categorize themselves on which type of person they are. Should they be aggressive? Should they not be aggressive? How should one allocate their portfolios on whether they should take risk? For what you said, for every let's say unit of risk they want to take, you should generate more returns than that. So how do they actually judge their risk?
I think that's why, a risk profiling needs to be done for every investor, right? I mean, it probably just depends on which stage they are in life. Are we talking about someone who is just approaching retirement? Probably their needs are very different. Or is this someone, who is just starting off with college or just entered their first job? So on that basis, it's just going to be different for each person. I think diversification, irrespective of wherever you are at whatever stage, I think it's still needed. However, the weight, what weight you're supposed to allocate to what asset class might just differ depending on what your needs and wants are.
One way to kind of, profile yourself is also kind of having a very clear sense of what your obligations and financial liabilities are. What tends to happen is it's not the strategy is broken, it's just that your staying power is less. For example, if you were to, hold on to a micro cap portfolio, and if you've got a salary and that's paying for all your expenses, and you don't need to see this money for the next 30 years, I wouldn't do anything that is conservative.
And by microcap, you mean a risk-on portfolio?
A very risk-on portfolio where you're looking for, very high compounded growth rates. Simply because of the fact that I don't have other bills to pay and my lifestyle is met completely with my other source of income. So sometimes risk profiling is not like this theoretical academic subject, but it's actually when do you have bills to pay. Let's say you have a mortgage on your home. You have to pay X lakhs a year as your EMIs, right? Does your salary cover for it or not? If it's covering for it and some, then I don't really see what's the point of playing defense, especially if you're young. So I don't think there is one answer that kind of gives you, but I would anchor it around my financial obligations and liabilities. That's how I would decide how aggressive do I want to go or not.
Do you think there are a set of questions or rules that one should answer before getting into investing?
I don't think there is a standardized answer. Like, you can have, let's say, person A and person B. Person A is a very frugal guy. He likes to live life very simply. Person B is a little more likes to enjoy his money. They may have the same age and the same net worth, but the risk profile for the frugal guy can be more aggressive. And for the guy who likes to enjoy his money can be a little more conservative. It may seem a little counterintuitive, but the frugal guy he does not need the money for anything else. So, I mean, what are you going to do keeping your money safe locked up in a debt market fund? It's kind of criminal waste of all the money that he's earned, right? You don't have expenses. You're not going to take risk. What are you going to do with the capital? Well, that's a different conversation. But in fact, I would kind of argue this food for thought that the guy who's a little more spendthrift should be a little more conservative.
I just want to add something, and I think this is something you had told me a long time back. I think this is when you were working on your earlier firm. So all you guys were making around 35,000 bucks a month, and I think this is what this is what one of the founders told you all, that this is the time where you kind of spend on experiences. Don't sit to be calculating, at least from this, that I need to save so much for an SIP, because you don't know where all these things compound. Like, very similar to the example that you just gave, right?
Yeah. So what the basic premise was, like, until the age of 32, whatever money you make, if you've got half a brain, even if you save everything, like if you don't travel by cab, you will walk. Instead of taking the taxi, you will take the bus. If you do all those things, right, you'll end up saving a specific amount. Let's call that X. If you've got half a brain, and if you back yourself a little, I mean, I know this, a lot of it is just speculation, but if you've got half a brain, whatever you end up saving and investing and compounding and doing all that right, doing 100 things right, will be your monthly paycheck at the age of 33.
Exactly, yeah.
Or maybe a quarterly paycheck at the age of 33. So my point is, should you want to, like, beat yourself up for 10 years and then anyways make that money just by doing what a daily this thing, or just actually invest in yourself where you're actually getting a chance to actually compound your terminal net worth by, like, multiples, so I think this is one of those things.
The main question was, if you have 5 crores today, how would you manage it? What would be the basic framework that you would follow to break that portfolio? How would you decide where to invest, let's say in equities, gold, maybe some other assets?
So we know one thing for sure. I'm not going to put all my money on one horse, right? I'm going to distribute it between guys. Now, when I'm doing that, position sizing becomes extremely critical, and we can lean on history to kind of get a sense of, understand the debt cycle, the economics of the country that we're talking about investing in, the interest rate cycle. Something as simple as if you measure Nifty in terms of gold, right? You will see a very stationary relationship between Nifty and gold. So when I mean stationary, is something that does not change dramatically over time. Like, every time when you take Nifty divided by gold, you will see the ratio just kind of oscillate between two extremes. right? So that is one of the many indicators that we would follow while deciding how much to weigh between equities and gold, for example, right? So there is just leaning on data gives you a lot more insight that helps us to take these calls. We can have a detailed conversation about it, but it's going to get fairly technical.
So then, let's say there are different parts to this. Most of the Indian retail people are focused toward equities, from what I know. No one is focusing right now, except for gold right now, which many people are talking right now. None of them are seeing other asset classes. So, what do you think about them, especially debt, for example?
Debt has been more of a convenience, right? I mean, at least we have never seen debt as an asset class, right? Because if you look at your inflation numbers, it's around 6%, but that's your consumer price inflation, which is around 6%. It's not that only money is being spent on your groceries and your buying wheat or rice, right? You're spending it on multiple things, like maybe let's say you're traveling or you're buying a car. All these things are probably in double digits. So 6% is not what the inflation number actually is. I'm assuming it's in double digits. So in such a scenario, I don't know, where does debt kind of help? Probably debt does help at some point, if you are just starting off and, if there is some valuation metric that kind of says that, you don't want to be invested. And of course, depending on where where you are in, which part of the market cycle you are in. However, at some point, I mean, you can be parked in debt, but at some point you kind of need to move to other asset classes which at least beat inflation. You have gold and then you have your equities. So I don't think so being in debt is a wise thing.
Got it. And Kavan, what do you think about other assets like gold, silver? People are allocating certain amount, but should the allocation be for return generating? Many people say that is only for maybe a cushion for your equity portfolio. Some people say it is for diversification. Both are for return generating. Right now, silver is being shooting up a lot. So people are speculating on silver to generate returns. So how do you look at this commodity kind of assets, mostly the precious metals, let's say?
Before I answer this question, I think I just want to tell you how we look at money, right? I think gold is God's money and everything is fake. Everything else is completely, it's man-made. It does not exist. It is just like people in a room pushing buttons on a screen, depending what suits their agenda. Now, having said that, it's important to understand that what do you mean by returns? I want to ask you, what do you mean by returns?
So the price that I'm paying after certain is I should get higher amount than that. That is my returns.
Okay, so price in what?
Any currency or yeah.
I'm saying that itself is a flawed way of looking at returns.
Okay.
What I would look at return is how many kilograms of gold do I own? And how many kilograms of gold do I own 10 years from now? If the number of kilograms of gold I own are not increasing in value, I am losing money. My returns are negative. When I say invest in gold, that is the all-weather bet that we're taking, that I'm not here to make returns, I just want to play defense. I want to walk out with, on the day 3 of a 5-day test match, being 8 wickets down. That's when I invest in gold. And what gold will do is it will block every ball for the next, forget the next 2 days, it will block every ball for the next 15 years if it has to. Because that is what gold does. There was some talk about it being grown in labs. I don't think that's going to happen in our lifetime. But unless man figures out a way to recreate gold, I don't see it happening. But if it does, until then, gold is that. And therefore, the allocation to gold is a short play without actually having to park yourself in debt, which is the biggest destroyer of wealth. Name one person on any list, on any wealthy list, that has put his money in a fixed deposit or government bonds, except some large central banks. An interesting conversation around that I want to probably share. Even within the central banks, right? There are riskier and there are defensive central banks and there are aggressive central banks. Now, if you look at the Indian central bank, what they do, they print money and they give it out to banks that comes into the economy by introduction of as loans. For every central bank, typically for the amount of currency that is in circulation, about 30% is what they own as real assets. Now let's talk about the central bank that treats this like a business. Like, let's talk about the Swiss National Bank. They print money and then they buy stocks of Meta and Google and Apple. And they've been doing that for years. As a consequence, the amount of reserves they have is almost 95, 96% and thereabouts compared to the amount of currency that is in circulation. And that literally has ensured them to, despite them creating money, the money is not entering into the system. It's not inflationary. It's causing asset inflation in some other part of the world. Because that money is chasing, every time there is a balloon that bursts anywhere in the world, they print money and go buy these stocks. Why we spoke about this is, minute we spoke about debt as an alternative. I don't think debt is an alternative at all, because debt is an alternative if you want to get poor. Even within the central banks, the country that is least allocating to debt has got the best reserves. So it's as at an individual level. Now we don't have a money printer at home that we say, markets are down, so let me just print some money and park in mutual funds. We can't do that. But the closest thing we can do is not invest in debt. Because number one, if you're getting 6.5% return, 1/3 is gone to taxes. You're left with 4% odd. Then there's inflation of quoted, which is what Karan pointed out, right? Let's look at where you would, like, typically anyone who's earning 20, 25, 30 lakhs per annum, they would take one nice holiday. The hotel rates that existed before COVID and what exists right now. A decent 5-star hotel in India would cost you 10,000 rupees a night before 2020. Now that number has gone to 35,000. Now, does that compound to 6% inflation? It doesn't. Debt is a surefire way to get poor. Therefore, gold acts like the proxy debt. Treat gold as a zero coupon bond.
To hedge the inflation.
So when you say that should you invest in gold to generate returns and people are investing in silver to generate returns, my answer is they're not generating returns. They are just protecting themselves from the gravity of central banks. That by keeping money in a bank, you're just getting poorer and poorer every breath you take. And that's the reality. It's obviously an exaggerated example that I'm telling you, but the reality is not very far from it.
Now the main question, how do you allocate inside equities? Let's say you get a dream model where you'll get a certain allocation key. Right now I want to allocate 60% to equities. Let's say this is your model what's telling you. Now from that 60%, how do you choose, or where should a retail investor try to put their money in?
So, of course, just I think the last question what Kavan spoke, right? When it comes to metals, when we are looking at gold and silver, right? Are they really, it's not like they're generating returns. They're only helping us kind of fight with the inflation, right? And of course, I think exposure to equity should always, of course, be higher. Now, even within that, the thing is, I think everyone wants to kind of follow the same blueprint that, you had a lot of your value investors, let's say like Charlie Munger, Warren Buffett kind of follow. However, I think it's not saying it's not possible, of course it can be done. It's a very tough game to play. In India, if you see, you have close to around 4,000-5,000 listed companies. If one sits to do research on them, you need to get into granularity as to what each and every company does. It's not as simple as you've read a newspaper article or, someone's told you some information. It's a lot more that you need to understand. Where each and every factory is, at what time or at what, where are the materials coming in, how many shifts workers are working at, and so, I mean, it's like getting down a rabbit hole, which I don't think so is possible for a lot of people, because it's not like a day job for a lot of people, people have other jobs that they're doing, but you cannot be allocating, you can't be deciding, let's say, I'm going to allocate 1 or 2 hours a day trying to figure this out. I mean, it's just a very tough game to play again. In these cases, I think, if you have a lot of these index funds and a lot of these passive funds that are there, I think it makes a lot of sense. Of course, even if you check the numbers out, passive funds have beaten, active fund managers. Probably the number is north of 70%. So, it's getting into stock selection is just, I don't think so that's the best way for a lot of people.
What's also happened as a consequence is that it's getting harder for an average Joe to just say, I like this business, and I think so, because I use, let's say, Uber, and it's so cool. मैं मंगाता हूँ, गाड़ी आ जाता है. So I think Uber is a great stock. That's the one up on Wall Street kind of Peter Lynch kind of a method. The world has become a lot more complex since then. So it's no longer that straightforward. And therefore we are seeing that passive guys are thrashing the active fund managers on a generalized level. Now talking about passive investment strategies, when you say passive, the one best, the proxy for global proxy for passive investing is the S&P 500 or the Nifty 50 or like your large cap index fund. Now, when you break that down, let's pick the parts of Nifty 50 or S&P 500 into its bare bone structure. What does it entail? What is Nifty 50?
The biggest companies in India, listed biggest companies in India.
So, is it a rule-based, objective strategy?
Yes.
Is it the smartest rule-based objective strategy?
Maybe not.
So Nifty is a badly designed quant strategy, which works. All that we are saying is, can passive investing be done smarter than Nifty? Can the rules of that buying the largest companies in the heaviest proportion and just rotating every like 1 year, 6 months, 3 months, can that strategy be more fine-tuned to deliver better outcome? The answer is a resounding 100% yes when you look at the data. Warren Buffett talks about buying low, selling high. I mean, initially that's how he started off with, at least. When he's proposing the S&P 500, he's basically going completely in the opposite direction. He's saying buy the most expensive companies out there because it's market cap weighted. You're buying more of the expensive stuff and not of the cheap stuff, right? So it's completely against what Ben Graham kind of told him, right? But he's saying that's what's working and that's fine. That's been working over the years.
However, if I'm just talking to about a normal retail investor, right, who does not have access to, or I wouldn't say access to information, but who does not have a lot of time to digest so much information, I think it kind of makes sense to have, instead of putting all your eggs in one basket, I feel it makes sense to be exposed to a little bit of everything. Of course, you might just play around with the weights, but sure, you know what, be invested to value factor, then there's momentum. And again, you can also have exposure to different other asset classes like, gold and other metals also.
I don't think you can completely blindsidedly follow data, but it's a great tool to lean on because it teaches you years and years of experience without actually having to be that old. Right? Typically the old saying is like, I am an experienced investor. I've been around for 40 years and there is a lot of truth to that. But like someone who's in his mid-20s, he can't just give up hope and saying, I'll wait till I'm 40 and then I'll start investing, right? So you got to do something about your lack of experience, and data kind of fills that gap.
There's a saying, right? In God we trust, everyone else bring data.
I wanted to jump back to one point that you had said, that you are not pro debt. Okay, I'll just add one question to it. Let's say there's this very poor guy who has come from poverty. Let's say he goes to KBC, wins 5 crore rupees. Now, for 5 crores for him is a very big amount. He's not looking to grow that amount, make it 50 crore, 500 crores. So he's not with that aggressive mindset now. So should he then invest directly in a debt or liquid product and not think about growth there? What do you think?
He should, if he wants to go back to playing KBC to earn a bread. 100%. See, think of it like this, right? Let's say you make 5 crores. Now you can buy a house or you can buy a Maybach. Debt is like buying a Maybach and living in it. You can buy a rundown house. It's not sexy, right? It doesn't look that great, but it's stable. That value is retained. You will never lose purchasing power. Now this guy got 5 crores and he said, I'll buy a Maybach and I'll live inside the Maybach. I'll have a bath inside, I'll eat inside. That is investing in debt. That's the equivalent of investing in debt, because the value of that Maybach is guaranteed to go to zero. Yes, it's giving you that stable 7%. That's where the sexiness of the Maybach comes in. But it is definitely going to make you poor. It's a mathematical certainty. There is no two ways about it. It's the same thing. I'd rather buy a plot of land, and there are a lot of issues with buying land with that 5 crores, and I'll gradually, in due course, I'll build a home, I'll deal with the government, which is proxy for volatility in an equity book. But I know that once I get this right, I would have left behind something for my kids, and my net worth is now not going to go back to zero. In debt, your purchasing power is definitely going to go to zero. So to conclude, I think debt is a great tool, like Karan said earlier. Like I think great is a great tool to park your money while you don't know what you're going to do with the 5 crores. KBC jeet liya. Now I wouldn't say that debt is a bad tool. Put that 5 crores हाथ में लेके घूमो. You'll have to park it somewhere, right? So that's the only utility debt has for short term, 1 month, 2 months, 3 months, 6 months, figuring out what is going on.
I had seen many fund managers right now are investing in China, Hang Seng Bees, maybe some other geographies also. What are your views on global diversification in your portfolio? Why is it important, or is it even important?
I think having access to global markets is a big advantage. Anybody who's been in the US for the last 2 decades has benefited tremendously. Dollar adjusted Nifty returns is only been 1.5 times US government GSEC returns over the last 20 years. Now that's crazy. You are willing to see 70% drawdowns so that you can just get 50% more terminal value than a US bond. Right? So that's definitely an edge to have access to international markets. And that's not to say US is great. That's not what I'm saying. I'm not saying that US will be great and you should put your money in US and AI stocks and no. So there are themes that needs to be studied carefully, analyzed, and then. But having the ability to move money from one country to another is a very big edge. When it comes down to there are many opportunities because like when you're from an India centric standpoint, we are evaluating the Fed and the RBI, and then we're looking at interest rate cycles and economic cycles and markets and gold in Indian rupee and whatnot. Your options are kind of limited. When that bouquet of options get if it gets broader and you have from Turkey to Argentina to South Korea to AI stocks in the US to real estate in Dubai, just having those kind of options will genuinely improve your risk adjusted return. Which, coming back to the original point, the idea is not to bet on one jockey. Just so that kind of diversification obviously is a massive edge. But does that necessarily mean everybody should buy into AI stocks? No. Right? There is a time and place for it. I think currently the way things stand, probably it's going to be it's a very risky bet, and context is important. But yes, I don't think blindly investing in global markets is an answer.
You both said we have to have certain allocation to equity, gold. If you have this diversified portfolio where we are investing in passive, won't you get very muted returns, 11, 12 kind of percentage of rolling returns? Now, if me at a younger age, I would want to take a very high risk. I would want to have very explosive return, even if the downside is very big. I'm okay to give that time to market. So I'm not able to figure out from this how could I have that exposure.
I think in case of, so you mentioned, right, we have certain exposure to passive equities, right? Out here, I'm not just talking about, and this is what I'm talking personally, right? It's not like I'm just going to invest in an index fund and just leave it out there, right? Of course, that's probably at like, we also spoke earlier in the episode that how you have momentum funds, which kind of do a lot more better. So even though it is passive, that does not mean your returns are going to be very muted, not necessarily. So, I mean, I feel you can still expect a, 20-25% return by investing in some kind of passive strategies. So, yeah, I think you can kind of get that kind of growth. And this is, again, something that I feel just suits the way I am. I mean, stock picking is something I would generally not get into. So, or maybe there's a certain amount given to some fund manager to do it, but I don't necessarily feel that by doing something like what we've just spoken about, you'd get like you're getting muted returns, you're getting you're just scraping the barrel. I think you can probably do pretty well as long as you kind of stick to.
So the consistency is the.
I think you need to know how to pivot. It's not that you're just holding on to something and then turning a blind eye to it. I think markets do evolve, right? So depending on, depending on where markets are and how the economic environment is, you might just have to pivot between asset classes. But this is, I'm saying broadly, this is something what I would do.
If you look at Buffett, how did he make his billions of dollars? Number one, he made most of his bulk of his money in the latter 10, 20 years of his life. So again, he wanted to get there fast. I mean, I'm not saying he wanted to get there fast. He was pretty stable, but if we want to get there fast, we need to understand the math of compounding, that on the last year, the amount of money you will make will dwarf the first 25 years of your existence, right? So some of it is just patience. And lastly, if you look at Buffett's balance sheet, like, it's not about the stock picking, it's not about where you're allocating the money, but also how you're constructing your balance sheet. Like I said, Buffett had access to a lot of capital that wasn't necessarily his at almost zero cost, right? When you go and sell insurance, you collect those premiums. There is liability, probabilistic liability on that capital, which is not yet ascertained, right? What if there's a volcano and a typhoon all within the period of 3 months and there's bankruptcy and whatnot? The insurance companies would have had a large claim, but all that money was parked in equity markets. What does LIC do? It collects premiums from endowment policy buyers and at the effective cost of capital of 4-5% and puts that in Nifty 50 and large cap stocks and generating 12-13%. Now for them, 12% is enough. They don't need more money, but they want certainty of the cash flow because they're leveraged. It's not a very direct form of leverage that you go to a bank, get a loan against a property and then buy stocks. You're not allowed to do that. But it is a form of leverage. It is a form of leverage. You have access to what I call OPM, other people's money. These are some of the things that have worked in the past. Will it work for someone like you? Will it work for someone like me? I don't know. But just to merely theoretically answer your question, these are some of the ways you can do it.
Maybe because on your small capital, if you have a goal that I want to be a billionaire or a millionaire, whatever, right? You cannot be generating 12% initially. And then, of course, there are different ways of also achieving it, just like Kavan said, what happens with LIC. But I think, it also matters where you are at the spectrum.
So, in conclusion, from what Kavan said mainly, you need to have a form of leverage. That's right. A form of leverage, not directly ki loan le lo.
Intelligent form of leverage, which is, let's say, running an asset management company. It's a form of leverage. Think about it. Where you're compensated for, let's say, I run a mutual fund company. I am collecting fees of 30 basis points on the AUM that I'm running. It's leverage. If my performance is not good, people are going to run away, right? But I don't have, it's one-sided leverage. Like, if my firm does well, if I'm able to manage and deliver people and give them results, more money will pour in. Therefore, my returns get amplified. And again, when Buffett was making 100% per annum, the financial markets were not as savvy as they are today. Right? It was easier to find opportunities. Today, everyone runs a family office. Everyone's an analyst. The proportion of people chasing down those opportunities are much higher. Everyone's looking at the same data. Everyone's hunting for that same alpha. It's become a white-collar contact spot. So you can learn from Buffett. You can learn some principles. Can you blindly mimic him? I don't think so. 50 years before today, he anyways had more money than what we would even dream of having in our lifetime. And he managed that money, and what we know of him in the last 50 years is documented evidence is probably something that if you blindly follow the Warren Buffett in its entirety and its absolute verbatim as his letter suggests, you can take broad principles. But if you follow him like just step by step, I don't think you'll land up anywhere. Because like you say, Purnanand, I'm going to buy Coca-Cola. Superb business. Yeah, sure. Your 5 lakh rupee portfolio will grow at a rate of 8% per annum. 9% per annum. Now do the math. Even after 50 years, where are you going to get to? So, I think you can take principles from Buffett. I don't think you can blindly follow him. And how Buffett manages $300 billion, we can't manage 5 lakhs. Right? It's a different. You can't. If you try to copy him, you will fall flat on the ground.
So, alright, it's time for the scroll check. We have pulled some interesting posts from the internet, and let's see how the fund managers react to these posts. So let's look at the first post. So a guy says, I sold my business for 7 crores. Markets are at an all-time high with Nifty about 24,000. Every advisor says time in the market beats timing the market. So I deployed everything last week, 60% in equities, 25 in debt, 15 in gold. No phasing, no waiting. Data says lump sum beats SIP historically. Did I make the right call?
Well, I think I would more or less agree with the person's approach. I think he's done a smart thing by not waiting for some. I think more money is lost waiting for a market crash than in the market crash. Since he sold a business, I'm assuming there is no cash flow, so he's parked some money in debt. The only thing I would do different is probably have a more like a more scientific rationale behind why he would pick these ratios, and 15% gold versus 60% equity. Is there can it be a little more? Can that decision be aided with some more insight into history and what is likely to outperform and at what part of the cycle are all these asset classes, both these asset classes are in? And secondly, lump sum, I would agree, would beat SIP. However, there is a risk with lump sum where you would get the timing absolutely horribly wrong. So the only thing I would do is probably put in some tactical hedges on the equity portion. Because let's say you did a lump sum in January 2008. I think you would not see light of the day until 2013. Yeah, so I don't think it's... in lump sum, you're always worried about one check, right? In that one check, what if you just are on the wrong end of that curve? That can be brutal. SIP, you're kind of saved from that, that any binary decisions are risky. Like if you're saying all on and all off is always a risky decision. If in SIP you're basically saying, okay, I don't want to go all on or off, I'll gradually build in. That's always a safer approach. But it's also, I understand the guy's conundrum, because sitting on cash is definitely death. So I think he's on the right path. The only thing I would probably add is like some tactical hedge on the equity portion on the book that can dampen the volatility in case he's timed it horribly wrong. In that way, what happens is you're not getting caught on the wrong foot for it's not that there is any probability of you not seeing light of the day for the next 5 years. In case there's a crash, you have a plan in place. And in case if there is no crash and the markets do what they have to do, I think that's a great outcome. I don't think there's going to be a problem. The only other thing is probably, as my hatred towards debt products is probably, if he can figure out another business, rather park instead of debt, he actually use that money to start another business that gives a much higher yield. That would be a better, if the guy sold a business for 7 crores, clearly the guy is capable. I'm saying that if he's of age, he could probably use that 25% allocation or 15% allocation to debt, whatever that is, into actually setting up another business line, which gives them a better yield for this rather than this, because debt is again death. That's how I see it.
So the next guy, I'll just read out his post. Why do people keep pushing international funds? India is the fastest growing major economy. Rupee depreciation means we gain from our currency weakening. Nifty has given 14% CAGR over the past 10 years. S&P 500 in rupee terms, maybe 12%, 13%. Plus international funds have debt taxation now. I'm keeping 100% allocation in India. What do you think about it?
I think it's a good strategy. I'm not saying that 100% allocation in India is bad. We are gaining from currency depreciation. If you own stocks like Infosys, TCS, then yeah, sure. Which are very export heavy businesses, that your EPS, the currency depreciation will trickle down in your earnings per share, which will lead to expansion in share price. But it benefits the exporters in a very in a skewed fashion. So it's still money going out of your pocket, technically. I mean, when you go liquidate and you want to take a holiday abroad, it's going to cost you more money. But yeah, it's not a bad idea. I mean, I don't think there's necessarily a bad idea. But again, the fact of the matter remains that Nifty in dollar terms has beaten the US government bonds in dollar terms by 50% over the last couple of decades.
Alright, speaking of questions, we have picked some questions from your DMs and newsletter. So let's get straight into it. I just received 5 crores from selling my business. I've never managed this much money before. How do I even start?
Okay, in this, I'm assuming, after this person has sold their business, I'm just assuming that they've priorly never had any kind of exposure to equities, right? So I think for someone like, you get 5 crores of liquidity. Of course, I think it kind of makes sense to, just test the waters initially. Of course, where you want exposure to equities, but it will also help, if you have exposure to, let's say, gold or silver or any kind of metals, so that it can absorb a lot of your volatility. And I think once you're a lot more comfortable and you've kind of understood how markets do behave, you can maybe, after probably 3, 4, 5 years, you can start depending on your risk appetite and considering you develop one, you can maybe switch to a lot more riskier assets.
Let's jump to the next question. I'm terrified of deploying 5 crores at current market levels. Nifty P is about 22. Should I wait for a correction or deploy now?
Again, I think it's a very genuine question, and the fear is real. Unfortunately, you don't have a choice but to not sit on cash for prolonged periods of time. It's again goes back to what are the other we spoke throughout the podcast, right? I think there is probabilistic death versus certain death. Like it's death by 1,000 cuts if you sit on debt. So the only thing you can do is probably diversify into a couple of asset classes and use smart hedging tools to kind of dampen the downside volatility that if at all you would face, it probably won't cut you that badly.
So thank you both for joining today for the podcast.
Thanks
Purnanand.
Thanks.
Great chat.
So if this conversation helped you think clearer, please consider subscribing to our channel, and for more market insights delivered straight to your inbox, hop onto our newsletter linked below. Till then, this is our time. Looking forward to meet you in the next podcast.